Well, again, good afternoon and welcome to today's presentation for Vinebrook Homes Trust. We're very pleased that you're able to take some time out of your day to join us for our event here this afternoon. My name is Chris Hackenmack. I'm a managing director with NexPoint Securities, which is the distributor for all sponsored offerings on the NexPoint platform. I'm pleased to be joined today by Ryan McGarry of Vinebrook Homes and Scott Simon of NexPoint Advisors. Ryan is the managing partner and chief operating officer of Vinebrook Homes, and Scott is the director of real estate product strategy with NexPoint. Before we get into today's formal presentation and I turn the call over to Scott, I'd just like to mention a few quick items. First is that we do have a large audience for today's event, and as such, all phone lines will be muted during the entirety of today's presentation. We do encourage questions, however, and we will have a brief Q&A session at the conclusion of today's event. If you'd like to ask a question, you can do so at any time by typing those into your Q&A window. Second, today's event is intended for financial advisors only, and it is being recorded. Today's event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of any related offering and their investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance. So with all that said, I'd like to go ahead and get started with today's more formal presentation. I'd like to now turn the call over to Scott Simon, Director of Real Estate Product Strategy with NexPoint Advisors. Scott, welcome, and the call is all yours.
Thank you very much, Chris, and thank you very much to everybody who has joined us today. Appreciate you taking time out of your day to learn more about Vinebrook Homes and why we're so excited about the opportunity in the single-family rental market. Today, we are going to be speaking about what we see as a fantastic opportunity, what Vinebrook Homes brings to the table, and also kind of who NexPoint is and why we feel like this was a great opportunity for us to get involved in as well. Well, NexPoint, as the advisor and sponsor to the REIT, we have currently almost $10 billion of real estate under management, with a significant portion, about 65% of that, in the residential sector, combining both single-family rentals as well as multifamily, with almost 35,000 units under management. So we have significant experience in this sector and felt it was a great match for us in the opportunity. What we believe is, what we believe to be a great match is for a couple of reasons. First, we have significant experience bringing REITs to the public markets. Our flagship REIT, NXRT, we brought public in 2015 and has been one of the top performing REITs since its inception. We have more recently brought Hospitality Trust to Toronto Exchange, NHT, as well as a finance trust here on the New York Stock Exchange. So we have a lot of experience with that and bringing success to the marketplace. Additionally, NXRT, our flagship REIT, really has a focus on workforce housing and that demographic. And we felt that represented a unique asset and differentiator for single-family rental, with not a significant amount of other institutional investors in that segment.
Great. Well, thanks very much, everybody, for joining today. Thanks, Scott, for that introduction, Chris as well. I know we've got some current investors on the line who are excited to hear about our results through the end of the fourth quarter of 2020, as well as what we've been up to so far in the first quarter of this year. And I'll be happy to talk a little bit about outlook. I know we've got a lot of new potential investors or advisors trying to get a sense of what Vinebrook is doing and learn a little bit more about SFR and our position within the industry. So hopefully I can give everybody a little bit of flavor of those two different areas. First and foremost, I think what we've seen over the last year is a tremendous amount of new interest in the single-family rental marketplace across all real estate sectors coming into and going out of the COVID-19 situation in 2020. It clearly was demonstrated that SFR is a long-term viable business, and we are now seeing a second wave of institutionalization occur as large players, both in multifamily, home building, and existing SFR entities, look to increase their capital deployment, given how well SFR stood up throughout the COVID-19 recessionary pressures, both in terms of high occupancy, high retention, and ultimately high collectability of rent, outperforming multifamily peers, and outperforming most other sectors of real estate. The interesting thing about that concept is that in addition to benefiting from all those things that are huge tailwinds for the SFR industry and will continue to be so, Vinebrook also finds itself uniquely and really solely positioned as the preeminent dedicated workforce REIT in the space at an institutional level, and therefore benefits from additional tailwinds and strengths that not only materialized throughout 2020, but we believe will continue to be a source of outperformance. So with that said, just to touch on SFR in general, obviously SFR has benefited tremendously from a decade of underbuilding of single-family homes and a complete imbalance between supply and demand. And we expect that to continue as we move forward. That is resulting in tremendous occupancy rates, rent growth, NOI growth, retention, et cetera. And we'll touch on that as well as our success throughout 2020 on collections. At the same time, we see that there is tremendous amount of institutional capital looking to move into the space, but unable to find strong operating partners to invest with. That's why you're seeing a lot of deals getting done with in-place operations already, like American Homes 4 Rent and Invitation Homes. And we're proud that Vinebrook Homes has competitive margins and results with those groups while being able to offer this product to accredited retail investors, a real opportunity for your investors to potentially get involved with a private company where institutional is having trouble penetrating into the space. Vinebrook itself got started in 2007, 2008, and while originally the industry of SFR, there was debate around whether it was a trade, whether it was temporary, whether it could truly match multifamily margins, we always believed that this was a long-term viable business, and that's why we set ourselves up to run a long-term viable business, being vertically integrated, sourcing our own units, being disciplined to our buy box, putting them back together with our own rehab teams to our standard, and then managing them with our in-place team. Because of our specific selection targeting workforce housing, what Vinebrook set out to do was to build a portfolio of SFR assets that have higher relative risk-adjusted returns, in our opinion, from our perspective, and relative to the rest of the marketplace. That means Vinebrook is buying a very specific type of house, typically between $100,000 and $150,000 in value, with an average rent right at $1,000 a month. And that compares with other large institutional players that are closer to $300,000 a house for their assets and $1,800 to $2,000 a month, $1,800 to $2,000 a month. So a very big difference there, but one that really makes all the difference, because what that means, given the inelasticity of rent, is that we've got a much more compelling cash flow yield that's fully covered from operations. And that's really what we've set out to do, build a high cash flowing business targeting a very specific asset. Now, the demographic that fits in that asset is also interesting because this is the customer that has, is, and always will be a renter. It's the customer that multifamily operators saw increasingly moving out of their properties to go to single family rentals. And we believe it's the right place to be for building a long-term viable SFR strategy. What do we want in high yields or in any yielding product? We want durability and perpetuity. And we believe the assets that we're buying and the demographic that we're targeting offers the most compelling picture to accomplish that. From our perspective, the SFR industry remains the largest, most fragmented commercial real estate sector, although there is continued consolidation, and we'll talk a little bit about where Vinebrook's participating in that. And that's especially true in the workforce or affordable segment. We face very limited institutional competition, with most operators gravitating to be above $1,200 a month in rent, with us at $1,000 a month in rent. There's a tremendous amount of biases that are feeding into that decision around asset age, deferred maintenance, and the performance of the underlying demographic in terms of credit quality. But as we demonstrated last year, our residents actually outperformed those higher price point residents. American Homes 4 Rent and Invitation Homes saw bad debt move from the 1 to 1.25% range to 2 to 2.25%, while Vinebrook moved only from 1 to 1.25% to about 1.6 to 1.8. So material outperformance on collections and bad debt, despite having a lower technical credit score quality resident. And that really comes down to our effective management of this demographic, matched up with the affordability that clearly is representative of our portfolio. We believe these assets are fundamentally mispriced even today after a decade of home price appreciation and tight supply as we see it today across single family assets. And that's really because, one, there's no institutional competition for ownership of our style of asset. And two, there is the normal market participant, the owner occupant, is fundamentally no longer participating in the marketplace. There's secular shifts away from the desire to own a home. There's challenges with credit availability, down payments, balance sheets, et cetera. And yet there's still tremendous demand to live in those houses. So we're benefiting on both sides, both limited competition for ownership of the assets, an opportunity to consolidate a tremendous amount of defragmented inventory with a very attractive cost of capital, and a demand picture which I would describe as insatiable. And that's materializing in 99% occupancy, 81% or greater retention, 10% lease over lease release rates with average days vacant under 10, and ultimately very strong NOI margins and growth as a result. We believe our portfolio is defensive, diversified. This is an asset-backed yield which serves as an inflation hedge, which may be becoming increasingly concerning to some investors, as we've seen recently with where treasuries are. And ultimately, we believe that defensiveness materialized and proved itself out in the last year. We always felt like, hey, this is defensively positioned because of affordability, but we didn't necessarily expect to be put to the test the way we were with the onset of COVID-19. And yet, as I mentioned, our residents held up, and we believe that continues to be a very interesting and compelling part of the story, that not only are you getting an outsized annualized distribution rate relative to other SFR options, currently just shy of 6%, where those groups are between 0 and 1%, but you're getting it in a portfolio that serves as an inflation hedge and that we believe is also very defensive. Folks can trade down into our asset in recessionary environments, and we've seen that with our top quartile of houses experiencing tremendous demand and rent growth. And at the same time, in the event that we need a floor, we could move to housing vouchers or Section 8. We don't currently, but if we found ourselves in a very deep recession or a long-term recession, even a depression, that would certainly be an option for us. And flipping that switch for perhaps the bottom decile of our assets would give us immediate full occupancy with zero bad debt. Obviously has an administrative burden to it, but we wouldn't sacrifice rent rates at all, while other groups would have to cut their rent by as much as half to take vouchers. So very interesting positioning there. We believe we've got a compelling total return picture, both in terms of the current income and distribution rate, which is supported with full cash flow from operations coverage, but also the opportunity to participate in private consolidation and growth at attractive cap rates, with a real cap rate compression and value creation story that comes from a potential public market liquidity event, which we are targeting and keeping our eye on, having surpassed what we believe to be the minimum floor of size for it to be viable. With implied cap rates today of the publicly traded entities being in the low 4s and our current distribution rate of 5.8%, plus buying cap rates at 6, 7, and 8% plus, investors, we believe, will benefit tremendously from that cap rate compression opportunity if and when that IPO occurs, which we are confident it will. So that's a very interesting thing as well. And when we talk to public market equity analysts, obviously, with such attention on single-family rentals, the public markets are interested in having more exposure to SFR that goes beyond two opportunities right now, AMH and Invitation Homes, that really are kind of the same flavor of SFR. And what we would bring to the public markets is exposure to different markets, a different demographic, similar operating performance, superior dividend yield, a different maybe defensive positioning, and that exposure to workforce or affordable housing on top of the SFR. So I think something that's very ultimately compelling. We manage this portfolio, as I mentioned, internally and with vertical integration. We've got a systematic and technological platform we've invested in over the last decade, which leverages a cloud-based infrastructure, maximizing efficiency, flexibility, and transparency. We have asset-level visibility into where every house stands, who's currently responsible for it, what tasks are associated with that responsibility, who's next in line, and automation to identify when things are bottlenecks. And it's all with a goal toward keeping or moving things constantly into cash flow. Just to hit a little bit more on some of the underlying fundamentals that I touched on already in terms of supply and demand, what we see is that the SFR sector overall is experiencing tremendous demand. Over the last decade, household formation has come primarily in the form of renters, and certainly this recent market disruption, particularly for our demographic, will ensure that they continue to be renters by necessity. And the tight supply of single-family rental homes means that ownership is even further out of reach, although desirability for SFR is still extremely strong. And that was emphasized even further with COVID as people really started to see the value in single-family rentals in terms of the square footage proposition, where you're getting a lot more bang for your buck, but certainly as well from the privacy, security, social distancing that single-family rentals offer. The amenities of an SFR. You may not have the pool, you may not have the clubhouse, but what you do have is privacy and distance, and that increasingly is becoming very valuable to renters. From a supply side, we know that our style of asset is not being built whatsoever today, so we don't face competition from new entrants in terms of new supply that would limit our rent growth or steal occupancy away, driving a need for concessions or challenging occupancy. We know that workforce or affordable housing is extremely underbuilt, and that will be a supply-demand tailwind that continues to benefit SFR in general, but certainly our segment of it for a long time to come. And as I mentioned already, what we know is that ultimately SFR gives folks more space at a discount, and it gives folks the amenities that are most valuable to them in today's world, which really is privacy, security, and space. The result of everything I've mentioned today is that since inception or formation of the REIT at the end of 2018 or the beginning of 2019, we've seen a 64.3% total return and a current 5.8% annualized dividend rate, which has not moved at all, which was not challenged whatsoever in the COVID-19 environment, and which we're confident we will be able to continue to deliver on. At the end of the year, Vinebrook stood at 9,283 homes, above our target goal for the year, having outpaced our growth goals and capital deployment goals. We had 97.5% occupancy, a 58% same home store NOI margin, just about a $975 average rent, and ultimately some very compelling same home store rent growth. You can see in the bottom left chart here that our same home store rent growth moved to over 5% on a blended basis in the third quarter, with over double-digit rent growth on releases in the third and fourth quarter. Those are trends that have continued so far in 2021. I think that really speaks to the demand. Somebody's moving out, the house is released within 9 days currently, and the new resident is paying currently 11% more than the person that just moved out. We did back off our renewal rates a little bit in 2020 as we wanted to understand what the operating environment would look like and be cognizant of a potential uptick in evictions. So you see that reflected there, but we have now moved to full pricing on our renewals as well, and we're anticipating strong blended rent growth into 2021, 5% or more on the year. And again, we are seeing those same strong release rates. People moving into those homes paying that double digit more than the last person are fully qualified, employed, pass all of our screening criteria, and are demonstrating that they have a paycheck to move in. You can see our current markets on the bottom right. We're very much targeting the Midwest, Heartland, South, and Southeast. At the end of the fourth quarter, we were looking ahead toward expansion into the Southeast through a number of portfolios, and I'll touch on that in a little bit as we did successfully close 2 of those in the first quarter. The reason we're interested in these markets is because they offer the perfect balance from our perspective of affordable housing, supply of our buy box asset, compelling cash flow yields, a demographic that's present and pays their rent, and ultimately markets that are strong. These are not extremely high growth markets. They are not markets where home prices are going to run away and price us out of our target yields, but they're also stable markets. And again, what are we trying to do here from a cash flow perspective? Durability. Well, we very much value stability. So we're looking for markets that have compelling population growth, stable job growth, no exposure to manufacturing-based employment or auto workers, and those types of things that give us confidence that we'll be able to continue to see these results in the markets we're in or that we intend to move into. From a historical standpoint, you can see we've got over a decade of experience growing this portfolio from our first home in 2008 to our 9,283rd home at the end of 2020. And as I mentioned, based on our growth to date through the first quarter, today we sit just below 14,000 homes, having closed 2 large transactions. So we've got a history of deploying significant amount of capital. And as we formed the REIT at the end of 2018, beginning of 2019, what I think we've demonstrated is that our platform is extremely scalable as we've successfully stood up new teams in new markets, deployed capital, moved those assets onto our platform, and done that all while increasing our margins and continuing to deliver our outsized relative yields. Diversification has improved as we've continued to deploy capital, both because we're entering new markets and because we've been able to really scale many markets up. And again, this is through the end of the fourth quarter, so you're seeing just shy of 10,000 units, which was really our floor for IPO viability. Today, we're closer to 14,000 units, which puts us well above that floor. And as we digest these most recent acquisitions, we'll be certainly working with our bankers, our capital market groups, and our friends at NexPoint to decide the right time. As many of you know, based on having more than 2,000 individual investors, we are already a public filer, publicly many of our statements here in April. So it's only a matter of time from our perspective. We are interested in reducing our equity cost of capital further so that we can continue to pursue the consolidation that's occurring in the industry. And that so far this year, we are leading the pack on across all of SFR, certainly on the workforce side. From an ownership breakdown, you can see what the equity mix looks like. A significant portion are individual REIT shareholders through various broker-dealer networks, NexPoint itself, and VineBrook in terms of the principals and owners of the company's investment, which rolled over from previous investors, and we believe ourselves to be highly aligned. At the end of the year, we have a net debt percentage or an LTV of only 35%, as we bought a significant amount of things with cash capital and we were opening new facilities. But today, following the acquisition of those 4,000 assets and a $500 million facility put in place with JP Morgan, we see our debt levels closer to 60% where we want them, and an effective rate that's lower than 3.3% today. So very compelling from our perspective borrowing costs. And we do anticipate considering a single borrower securitization, which we believe would come in well below 3%, bringing our cost of borrowing down even further, and again, shoring up that war chest for continued expansion through portfolio acquisitions. So what are we actually doing? Here's some screenshots for you to give you a little bit of flavor. This is a typical interior renovation for VineBrook. It's addition by subtraction, it's updating, and it's making things safe, functional, and clean, and efficient in terms of serviceability. And that's really what we're trying to do here. We don't compete on amenities. There's no granite countertops and stainless steel in our homes. What we compete on ultimately is price. And next to our mom and pop competition, safety, things being functional, and cleanliness sets us apart. Our leasing agents absolutely work very hard, but our houses very much sell themselves because of what we're up against in the community, and providing both cleanliness and professional management available 24/7 is a big differentiator relative to other options that folks at this price point might be exposed to. Clearly, a big concern for any investor would be, well, what happened during COVID-19? Did people actually pay their rent? And for us, the answer is overwhelmingly yes. We certainly saw an uptick in bad debt, as everybody likely did in residential, but it was not severe. And it was ultimately better than I think we anticipated about a year ago today when COVID really started to emerge. VineBrook has a very disciplined approach to collections and our accounts receivable. And that's something we stuck with throughout the pandemic and continue to do today. We did stand up a hardship program to help our residents, knowing what our goal is within our communities of supplying affordable housing to people. But ultimately, in typical VineBrook fashion, we did require people to qualify and demonstrate that they were qualified, providing the proof of loss of income, and ultimately making new agreements and signing off on those agreements to make good on the promises they were making. Less than 5% of our portfolio opted to pursue a hardship, and overwhelmingly those hardships simply people were asking to pay that current month's rent in that month spread out over 2 or 3 payments. And they performed at about the same level as our overall collection rate, so about 98 to 99% performance on those hardships. And so the result is, over the course of the year, we've essentially collected 99.9% of our historical collections. Like I said, certainly an uptick, but one that was much less severe than potentially anticipated, and one that wildly outperformed the other entities in the space that publicly report, particularly given our affordability, and despite us seemingly having a weaker credit profile for our residents, which I think is very interesting and kind of gets back to that defensive nature. Credit score is not a great predictor of if somebody's going to pay their rent to keep a roof over their head, and they overwhelmingly did. Just a look at our actual platform, and this is really how VineBrook manages this. Clearly, the biggest challenge in SFR is that these are disparate assets relative to multifamily, and that we very much rely on our field-based team to get efficiently from property to property to take care of their tasks. We manage that through technology, cloud-based technology solutions, as well as a platform that gives us tremendous visibility, leveraging task-based workflow. Every member of our team knows what success is for their position, and their position is guided by a series of tasks in a workflow that they can't necessarily deviate from, and that are designed to be as efficient as possible so that our people are ultimately being as productive as possible and leveraging their expertise in the unit, whether that be leasing a home, conducting the sales process, inspecting the home, rehabbing it, et cetera, not coordinating the activity. That's where we leverage automation, AI, and rigid workflows to drive that. So folks are spending time where they're an expert and not in kind of the organization or delegation, which can be handled systematically. So you've got some examples there of how we route our maintenance team efficiently by location, time of day, traffic, et cetera, how we identify our acquisitions pipeline, how we monitor activities. These are the things we're doing to shrink the footprint of managing these disparate assets, and it's really been a differentiator for how SFR ultimately has been able to perform. Certainly at the onset of the industry, multifamily investors were skeptical about the ability for SFR to perform, and what we've seen instead is that successful operators, of which there are few in single family, have produced margins better than multifamily, with American Homes 4 Rent and Invitation and VineBrook in the 63 to 65% same home store NOI margin. That is very competitive with the best or even better than multifamily publicly traded entities. In fact, Invitation Homes in the fourth quarter brought their NOI margin over to 67%. And really the big reason for that is because of how great the retention is. 81% retention across the industry. That means the average lease is over 4 years. People stay put. They stay in the houses quite a long time, and therefore turnover cost and vacancy loss is very minimal. Ultimately, our goal, as I mentioned, is to continue to scale privately, deploy the capital that we have, and deploy our war chest, be a net consolidator. We believe the consolidation opportunity is most ripe in our price point, where mom and pops own VineBrook style of houses, not other style of houses that are in the SFR industry, and where there are other operators that we believe we can target to take over, similar to the ones we've done in the first quarter of 2021. Pushing further and digesting those entities, getting them into our processes and levels of performance, and then ultimately pursue that liquidity event, which we believe is most viable via an initial public offering, given the cap rate compression opportunity that's available to us. Obviously bringing liquidity to our investors, although we hope they'll stay invested with us, but bringing our cost of equity capital down further to continue that growth. And just to conclude here, there's a look, as you can see, at what those implied cap rates are as of the end of the year, what Vinebrook's were as of the end of the year, and potential base conservative and optimistic cases of where NAV could go if given a valuation that the public markets are given today. Before I transition into a Q&A, which we're excited to do, just a little bit of flavor on what we've done in the first quarter of this year. Already through the first quarter of this year, we have met or are close to meeting our total deployment goals. We've closed on nearly 4,000 assets since the first of the year, taking out half of our most proximal competitor, Conrex, who was recently purchased by Brookfield, in 2 transactions. That's allowed us to spread into the Southeast with material footholds, some markets as high as 800 units right out of the gate. We've crossed over 330 employees with another 50 open positions, and we have stabilized those teams and onboarded those units with a significant of those residents already converted to Vinebrook's lease and already outperforming in terms of the historical financials we were provided in terms of bad debt and occupancy. It's going to take us time to fully turn over or retrain those residents, set expectations, et cetera, but we're off to a start that I think we feel is ahead of the game. We're excited about that our system onboarded those residents at the push of a button, demonstrating its scalability without error. And all along the way, our core same home store portfolios are outperforming. So through both January and February, and as we'll see on our next call when we've got Q1 results, we are outpacing our NOI margin goals, our revenue goals, and our expense goals already this year as a repeat of 2020. So from our perspective, this year will be about continued capital deployment with the lowest cost of capital we've ever had. We believe there are several additional large portfolio transaction opportunities that fit well within the Vinebrook buy box. We're excited to welcome thousands of new residents and give them a better, what we believe to be a better property management experience that's likely to translate into significant NOI growth for those portfolios over where they were acquired. And ultimately, as we stabilize, look ahead to that liquidity event in the public markets. So it's probably a good place to stop, and I'm happy to answer any questions that may have arisen.
Thanks, Ryan. Great job. We are very excited about the opportunities that present itself in single family and rentals and what Vinebrook, the opportunities with Vinebrook bring to the table. And that's kind of what you've just heard, a little bit about those opportunities, why we like the sector, why we think it's such an amazing time to be, to get involved in single family rentals. But what is Vinebrook Homes Trust, and what are you actually investing in? Well, Vinebrook Homes Trust is a Reg D monthly NAV REIT for accredited investors. We just came out with our February NAV a few days ago, and we'll be coming out with the end of March NAV first couple of weeks of April. You know, we have, even though we are Reg D, we're in a unique position because we have crossed the 2,000 investor mark for the Reg D, and we will now be filing as a public filer. So you will be seeing our 2020 audit come out in the next couple of weeks, and that will be as a public filer. And then moving forward, we will be doing 10Qs, 10Ks, 8Ks, just as you might see as a public company. So we're really moving in that direction. Not only are you getting an incredible amount of visibility into the share price and the valuation of the REIT, which is fairly unusual for a Reg D, but you're also getting an incredibly tax-efficient yield. In 2020, over 97% of the income was tax-deferred, and the portion that was taxable potentially could qualify for the QBI deduction, the qualified business income deduction that was put in place with the 2017 Jobs Act. It is a 1099, so despite those tax efficiencies, it is still perfectly acceptable for an IRA and other qualified accounts. There's no anticipated UBTI, so you can still get a very attractive income with a tremendous capital appreciation potential. You know, that's really what the goal of the portfolio is to provide a tax-efficient yield with capital appreciation potential. We are into the term of the offering from, with a 5-year term initially from November 2018. So we feel that within the next we'll be able to have a liquidity event within that time frame. Obviously, there are 2 one-year extension options. We believe that we might even be able to exceed that timing and provide a liquidity event before the specified timing in the PPM. We've seen an incredible return so far. We're providing currently it's a 5.8% yield on approximately on NAV. We have total return of 73%. If you're reinvesting your dividends, annualized return of 26%, on NAV. So really, we're trying to implement our investment thesis, providing a durable, defensive, diversified portfolio, providing attractive current income with capital appreciation potential, and that is our goal, and that's what we've looked to accomplish moving forward. And with that, I will pass it back to you, Chris, for the question and answer.
Thanks, Scott, and thanks, Ryan, for taking the time today to visit with everyone and give a very thorough overview and update on Vinebrook Homes. We will transition to the Q&A portion of today's event. Again, all the phone lines are muted, so if you'd like to ask a question, you'll need to do so by typing those into the Q&A window, and we're happy to answer any questions that you may have at this time. So, Ryan, I got a few questions here that have come in during the course of our presentation. First one's just asking more about expansion markets and where you might be expanding to, and asking if there's any properties right now in Colorado or even more specifically Colorado Springs.
Sure. No, at the moment there is no plans of a westward expansion and nothing in Colorado. Very much focused in the Midwest, Heartland, South and Southeast. I think we're, after the most recent Q1 expansion, we find ourselves in 19 markets. So we're focused on scaling all of those markets to our target minimum size of 500 and secondarily 1,000 units. Next potential markets on the horizon would be Florida, where we have no presence currently. Certainly Jacksonville is interesting to us. Although we are now in Georgia, we do not yet have a presence in Atlanta, which is a large SFR market. It's something we're keeping our eye on as well. So largely would expect more of where we are and or kind of additional movement into the Southeast, but do not anticipate going kind of westward.
Great, appreciate that, Ryan. Next question is asking about the impact or the expected impact on the recent acquisitions that you just mentioned once they've been integrated into the portfolio and on FFO specifically.
Sure. That may be something we'll have to follow up offline. I don't have those types of numbers right in front of me here, but what I would say is that the portfolios we acquired because they were underperforming. Their investors were looking for liquidity, as they had certainly seen great home price appreciation, having bought the houses, 5 to 10 years ago, but they were not deriving any yield from those items. And so we're talking about portfolios that had kind of 40%, 45% yields. And we're confident these are houses right on our same streets with our exact same resident in them. We're very confident we'll be able to move those into our target same home store 60% style margins, depending on market size, 60 to 64%, which we believe will be extremely accretive to the REIT as we fully stabilize those marketplaces. The budget for 2021 sees revenues crossing over $120 million per year. So certainly we, with similar margins, are anticipating, a significant growth in overall portfolio CFFO.
Great, certainly do appreciate that. Next question is also about, the acquisitions. It says, is 1,000 home acquisitions per quarter the target now with market expansions?
It's around there. I think 1,000 is probably a little bit, in more normal times, I would say yes. We all know there's a bit of a supply constraint. I think right now, last year we averaged a little over 200 homes per month in 12 markets. So if we extrapolate that out to now being closer to 19 markets, recognizing that there's some supply constraints until we get into the spring selling season, as well as some of the markets we've moved into not as being as big. I probably wouldn't say it's going to be linear growth of that kind of 2,000 plus a year. But I think our goal is to be growing organically, that is with just our normal bread and butter transactions by 2,500 to 4,000 assets per year. And then obviously portfolio transactions will be great complements to that.
Perfect. Appreciate that, Ryan. The next question here is actually asking about NAV and how Vinebrook determines NAV with 14,000 homes. Are they all being appraised?
Yep, great question. Yeah, the NAV valuation process is certainly worth highlighting. Vinebrook uses a series of asset valuation models provided by third-party information brokers to create a asset-by-asset valuation given those AVMs or asset valuation models. And those AVMs are brought forth by groups like Zillow, Black Knight, which is what's used for all Freddie and Fannie loans, as well as House Canary and CoreLogic. We put those different data fields into a single database. We identify outliers and make adjustments if necessary. And we carry any recent acquisitions simply at basis until they have actually been rehabbed. So there's significant embedded growth in our NAV because there's about 1,000 units still in the rehab process that have not been revalued to current NAV. That set of AVMs is delivered to another independent group, Raymond James Investment Bank, who validates the methodology, looks at what we've done, scrubs it for outliers, and makes sure it all checks reasonability. And then their work is independently reviewed by Houlihan Lokey to ensure that we're maintaining the exact process that's spelled out, I believe, in the PPM or offering memorandum, so that it's third-party validated by third parties. And that process is overviewed by a third party, trying to be as independent as possible. We are also working on a valuation methodology leveraging John Burns, as well as the Green Street Advisors and potentially Roofstock, three SFR industry experts, to start to look at our valuation on a cap rate basis, particularly as we think about that public market valuation and where our assets would be appropriately valued. The AVMs are clearly transactional and backward looking based on kind of MLS and transaction data, where portfolio transactions and things are trading today are very much forward looking. So I think we're interested in understanding what the gap there is in terms of additional compression opportunity.
Awesome. Certainly appreciate that, Ryan. A few more questions here. The next one is actually asking about added interest and entrance from institutional players into the SFR space. And with that, are we seeing any increased competition from institutions for homes at these price points?
That's a great question. Yeah, I mean, like I said at the top of the call, there has been tremendous institutional capital looking for entry points into SFR. You know, certainly folks that are already dedicated REIT investors or real estate investors have seen now SFR, given how it performed in the last year, as a necessary exposure in terms of a well-diversified real estate portfolio. We're seeing large national public home builders starting to say they're going to dedicate resources to build for rent. And we know there's a decade of underbuilding present. And given where consumer tastes are, it appears to be a very much a permanent fixture that a portion of home building will come in the form of building homes specifically for rentals. Largely institutional capital up to this point has partnered with existing players that do not compete with Vinebrook. So we've seen JVs done with Invitation Homes and American Homes for Rent, as well as Pretium's partnership with Progress Residential to take Front Yard or Resi private earlier this year. We have not yet seen tremendous institutional competition or capital come into Vinebrook's affordable segment of the marketplace. As I talked about, there are a lot of biases about, geez, what is a $100,000 home look like in the Midwest? And if we've got anyone on the call from there, they know those are leave it to beav it neighborhoods. You can go on our website and see them. They're perfectly strong and perfectly viable. But there's still biases out there around deferred maintenance, although we've demonstrated that we're spending the same amount as others And we think we're putting the right amount back into their houses where they may be currently underspending. And that at the end of the day, after several turns of a resident, all rental houses really start to look the same. Maybe not on price point, but certainly in terms of operating costs and how residents live in these homes. And so we prefer to start with a much higher starting gross yield. That's not to say competition won't come, but we feel ourselves way out ahead with over 14,000 units in this space and a decade of operational expertise in managing this demographic successfully.
Great. Certainly appreciate that, Ryan. I do have another question here. I think you addressed this a little bit earlier in the presentation as well, but just asking if there's any concerns about the COVID stimulus ending based upon, either our markets or rental demographics.
Yeah, it's a great question. When at the outset or even throughout the COVID crisis, we obviously did not consistently anticipate new inbound stimulus to our resident base. Each time it showed up, obviously that did help those that were delinquent get caught up. But we've all very much heard about the kind of K-shaped recovery, and I think that's what we've seen with our own resident bases. Yeah, we have a portion of our portfolio that has need to leverage our hardship program and who does have those stimuluses as a saving grace. But ultimately, we have a lot of our portfolio that they didn't skip a beat. They didn't lose their job and they kept on paying their rent, and they were probably happy that their rent was so affordable. So I don't think we have, although obviously it has buoyed us just as it has everybody else in this industry, I don't think we would have seen significant changes in our bad debt had that stimulus not materialized. I mean, only a handful of folks have actually pursued that hardship program, 5% of the portfolio or so. And so, I would say the people that needed the stimulus just to make rent and the folks that pursued a hardship are highly correlated.
Great. Well, again, I certainly do appreciate your time here this afternoon, Ryan and Scott, and I appreciate everyone spending the better part of an hour with us and taking time out of your day. I know we see a lot of familiar faces or a lot of familiar names here on the list with us here for all of the attendees, and some new ones too. So if this is your first time getting a chance to hear the Vinebrook story, we certainly do again appreciate you taking the time. And I'll ask that if you do have any further questions, you can certainly reach out to your external or your internal wholesaler. We'd be happy to answer any additional questions that you may have at this time. And again, just thank you everyone for taking that time out of your day. With that, Ryan, I'll just hand it back over to you to see if there's any closing remarks that you may have.
I just want to thank everybody for their time. If you or your clients are a current investor, we thank you for your ongoing support. Hopefully everybody's been happy with the returns we've been able to produce so far, and we're excited to continue to tell our story. And for those that are considering investment or investment for their clients, we're happy to answer any follow-up questions you may have, but we're excited about the outlook for 2021, both in terms of growth, continued margin expansion, and ultimately, the yield we're delivering in a pretty yield-starved environment. So I think it checks a lot of boxes and is worth a close look.
Great. Again, appreciate it, Ryan. Appreciate it, Scott. And thank you, everyone, for taking time out of your day to join us this afternoon. That will conclude our event for today. Thank you.
Thanks, everybody.
Thanks,